Um, let's go ahead. It's 10:01 on this. This is our, I guess, would this be our first, maybe our second official meeting, our first official meeting on the day that we designated as our meeting time for the MCE Finance Committee meeting on this Thursday, March 26th. If we can go ahead and move forward with roll call for a quorum.
Thank you, Chair. Belvedere,
Present.
Lafayette, oh, thank you. Larkspur,
Here.
Napa County,
Here.
Vallejo. Quorum established.
Excellent. We're going to go to board announcements, but I just want to, we have some new committees, and as we start, I want to start with the focus of this committee, if you will. And this is because I was just to make sure that we're on point here, because we have all these other committees, right? So the Finance Committee focuses on general issues related to MCE finances. Our job is to receive, review, and discuss quarterly and monthly financial reports, the annual audit, and the rate and budget setting proposals. We will also review contracts for financial vendors and may choose to make recommendations to the board on MCE policies related to finance, such as our reserve policy and investment policy. So just wanted to start with that understanding of that's our job here. Do we have any board announcements? None?
No.
Okay. Very good. Moving on to public comment, public open time. Is there anyone in the public that would like to make a comment?
I see
Not-
raised hands online, Chair.
No hands?
No hands.
Okay, excellent. Moving on to the consent calendar from our meeting on February 9th, 2026. Are there any changes to the meeting minutes? Oh, Catalina?
Chair, perhaps I have the wrong agenda, but I have an agenda that indicates the next item is the selection of the vice chair.
Oh, let me look. Did I just jump over that?
And perhaps our clerk can help me if we have the right.
I show it's item number 6. I show we're doing consent, then reporting from the chief operating officer, and then vice chair. Do I have a different agenda?
I might have pulled one, so apologies.
No, that's the one. I have the one where it's
Vice chair's next.
3 and then consent is 4.
Yeah,
Okay.
that's what I have as vice chair is 3 and consent is 4.
The selection of vice chair is item number 3.
Okay, let me look at this here. I printed. I have a printed copy. Let me see if my printed copy is the more current copy. Oh, interesting. This one is different. Okay, I apologize. I think there was an attached agenda, probably a previous agenda before. Okay. I'll look at this printed copy. So, selection of vice chair, item number 3. Any discussion on this?
I'd like to make a motion to appoint John McCormack as Vice Chair.
Good. Thank you for the motion. Do we have a second?
I'll second.
Thank you for the second. Roll call, please.
Belvedere,
Yes.
Lafayette,
Yes.
Larkspur,
Yes.
Napa County.
Yes.
Motion carries.
Excellent. Thank you. Let's see here. Now we're moving on to the consent calendar. For the meeting minutes on February 9th, 2026. Are there any changes on those meeting minutes? Seeing none. Is there any public comment on the meeting minutes? Not seeing any. Do we have a motion to approve a consent calendar?
So moved.
Second.
Thank you. Roll call, please.
Belvedere,
Yes.
Lafayette,
Yes.
Larkspur,
Yes.
Napa County.
Yes.
Motion carries.
Excellent. We're moving swiftly, which I love. We're on to item number 5, a report from Chief Operating Officer.
Yeah, thank you, Chair. Some financial news from MCE. I'm going to concentrate a little bit on the financial security requirement that we are obligated to comply with. The FSR is a financial instrument or insurance tool that covers re-entry fees, including incremental administrative and procurement costs stemming from a mass involuntary return of MCE's customers to PG&E. According to Senate Bill 520 of 2019, it was designated the investor-owned utilities as the provider of last resort, which is POLR, P-O-L-R, for their respective service territories. A POLR is the entity required to serve customers if a load-serving entity or a CCA or an energy service, electric service provider fails and can no longer serve its customers. Existing customers of the POLR must be protected from any cost resulting from a mass involuntary return of CCA customers to the utility. CCAs, therefore, are held financially responsible to cover the cost of re-entry to the IOU. Under statutory requirements, MCE is required to post an FSR in the form of a surety bond, letter of credit, cash security deposit, or equivalent evidence of insurance or parental guarantee from an investment grade rated institution. Finance department at MCE is looking into this matter to find the most affordable way of posting this requirement. MCE and other PG&E CCAs have historically posted the minimum FSR amount because PG&E has had a high generation rate, and CCAs have had lower PCIA charges. As you know, in 2026, the drastic decrease in PG&E's generation rates and increase in the PCIA charges result in significant lower incremental revenue from returning customers and proportionally higher FSR. So PG&E's calculation of the FSR is complex and opaque. The actual forward energy prices that PG&E uses in their calculations are kept confidential. Generation rates and PCIA charges PG&E uses are known after PG&E files an advice letter and shares MCE's FSR amount 60 days prior to the posting date. The FSR for some time used to be $147,000 prior to the methodology changes implemented in 2025. Now the minimum is $2,572,396. That comes out to $4.24 per account for 606,697 service accounts. The rough estimates that we have at this time in May of 2026, FSR could rise from $2.5 million to $27,740,514. And we are also estimating that in November of this year, 2026, FSR could rise from the May number of 27 million to $79,599,179. The proposed budget for the approved budget, the board approved budget for this upcoming fiscal year has allocated $1 million towards banking fees in light of these requirement increases that we are seeing. On another note regarding California Community Choice Financing Authority, after discussing at the board level at the CCCFA the administrative confidentiality, cybersecurity, financial, and strategic needs of CCCFA, the board did a robust search and approved recently Steve Reimer from MRG Consulting to become its first general manager. And since 2021, the start of CCCFA that MCE helped kickstart it, has issued over $25.4 billion in renewable energy prepayments that provide significant amount of lowering costs for the participating CCAs. And lastly, I want to do a little congratulations to our finance department. We're really pleased to announce that S&P Global Ratings reaffirmed MC's investment grade A rating with a stable outlook. And that completes my report, and take any questions if board members have any.
Thank you very much for that.
Oh, Dr. McCormick?
Yeah, thanks. Thanks, Vic. And so the increase, this increase in FSR, is this a surprise? Those amounts that you just stated are staggering
Yes.
amount of increase.
Yes.
So I guess two questions is, so you're saying well, multiple questions, probably. But first one is, so it could rise to 27 million in May and 79 million in June. That's just a bond we have to post, or we just have to show evidence of. I wasn't clear if we actually have to. It's an outflow of money, or we just have to post evidence that we could manage that amount if needed.
It's the latter. It's the
Okay.
Maida and Efren are looking into the best instrument, the cheapest instrument that will be able to make us show that to the PUC and PG&E that we are complying with the requirement.
So it's just, if it's just demonstrating our ability to pay, then I was unclear how that, you said it was part of the $1 million banking fee budget line item. Is that just kind of like the overhead required for the team to figure it out, or what's
Yeah,
the
well,
plan?
it costs money to get a letter of credit.
Okay,
And
okay, so that's
$80 million. We are assuming to be about $1 million cost to us.
got it. Okay. And I'm sorry, and does every CCA have this level of, are we singled out, or is every CCA is gonna be at this level?
Yeah, we are about 1,350 megawatt or so load at the peak with
Mhm.
our volumetric energy calculation. We are similarly situated with like AVA, CPA. With Edison, it has a little bit of a different number because Edison's numbers are different than PG&E. But in general, similarly sized CCAs, we're about the same thing.
Okay, thank you.
Yeah. Director Wilkinson?
I think actually you just answered all of the questions there.
Okay.
So the best way to do this is always through a letter of credit. You're saying there are other financial instruments out there. So I'm just curious whether on those letters of credit there are exclusions around those type of events, or it's specifically designed for that type of event.
It's specifically designed for that type of an event. And we are looking into the first option I shared was something we are looking into. It's about before the letter of credit, there are some like bonding methodologies that we haven't used it before, but we're investigating to see if that would be cheaper for us to show this evidence. And we can report back at the next meeting about which way we are leaning.
Okay, thank you.
Sure. Any other questions? Okay, thank you.
Sorry, Vic, and one last
Oh,
question.
Director Andre, yes.
So if we just have to post, evidence, I mean, we have plenty of reserves. Would they not take that as
Oh, yeah.
evidence of, us being able to pay this in the event of,
Yeah, a good question, Director Andre. But if we cannot just point to our reserves, we need to draw from our reserves and give them the cash, and we'd rather not do that. So we need to show that they have something they can lean on if this mass exodus does happen. So we cannot just show it to our account. They need to have something they can grab and use it as evidence.
okay, so they want us to post collateral and they want to hold the collateral. Is that what I'm hearing?
Yes.
Okay.
Right.
All right.
So letter of credit or a bonding is an easier and a much cheaper way of taking care of it. And if and when the formula changes, as we expect the PCIA to change dramatically by the end of the year or so, those formulas will be readjusted.
Okay, great. Thank you.
Sure.
Thank you for all those great questions and thank you for the response. Megan,
Sure.
any public comment on this?
I do see a raised hand from Dan Fageden.
Thank you. Dan, you're I'll
Yeah.
get started. You have 3 minutes, okay?
Yeah, I hear you. There's always a delay, just so you know,
Thank you.
to get to the unmute. Anyway, hey, Vic, and thanks for that report. I obviously you alluded to that the amount is stratified by size of the CCA. I was curious, do they stratify it by some type of risk, or is it absolutely, if you're the same size CCA, is it absolutely the same charge, or do they do some type of risk assessment stratification? Thank you.
Oh, thank you, Dan, for the question. If I may, Director Alessio, just wanted to answer this question. Thank you, Dan, for the question. It says like a secret formula that what we don't know is their market-based calculations. Other than that, there is no risk assessment for a particular CCA. This is more or less. So if the load, the megawatt load and the volumetric usage is the same, the numbers should be the same. There is nothing else. But behind it, we don't have data to show what are the numbers that are generating these dollar numbers. So I hope I answered your question then.
And that's baffling for somebody like me, Vivian. It's like, how can we not know? Like
Yeah.
that, have that information. And is that part of the legislation or just part of the sensitivity and the confidentiality of?
I can check with policy and get back to you, but my understanding
I'm happy to also jump in
sorry,
on that,
Iman, go
Vic.
ahead.
Yeah, no worries. This has there's been a proceeding on the provider of last resort or polar going on at the CPUC for many years. It actually goes back at least 10 years. And we've been active in that proceeding when it's been going on. The way that the FSR is calculated under the polar proceeding has been a key advocacy focus for our staff over many years. And believe it or not, the outcome could have been a whole lot worse. I think our team did a great job and we collaborated with CalCCA to end up with the current result. At one point, there was a consideration of having it get updated every single month, having it follow the market, having a lot more uncertainty incorporated into the formula. So I just wanted to let members of the public or board members who want to understand more about the reasons behind the FSR. There's a lot of information on the CPUC website and a lot of filings that MCE has submitted to advocate for stability in the FSR posting.
Very helpful information. I don't see any hands from directors. We've already had public comment. Is there any other public comment?
I
Tanya?
see no other raised hands online
Okay,
too.
perfect. Just want to make sure. Thank you very much. Moving on to item 6, which is the MCE Monthly Treasurer's Report for February 2026. This is a presentation information item only. Who will be presenting this?
Hi, Chair. That will be me.
Thank you. Thank you, everyone.
And if we can, perfect. So this would be item 6. Daniel, this is item, I think, 7 that you're presenting. It's not a slide deck, Daniel. It's just a report. It looks like a staff report and it has some attachments. Yeah, that's the one. All right. Good morning, directors. So my name is Efren, and I'll be presenting this item today. Maida is on a well-deserved vacation, so I'll be helping out just for this item. So on the screen, you have the latest Treasurer's Report showing activity for the month of February 2026. We provide this on a monthly basis for any activity that took place in the prior month. And every quarter, we also provide a more detailed report that includes, in addition to what we show here, it also includes financials, customer statistics, and a series of charts on actuals versus budget. The monthly version doesn't do that, but it does show the investing activity. So we'll walk you through this report, and then we'll open it up for discussion. And our investment advisor is here as well, so it's a really good opportunity to dive into the weeds of MCE's investment program. So if we can scroll down a little bit on this report, the report starts with a very short staff report. It's very boilerplate at this point. It describes the activity that took place at US Bank and River City Bank. These are the two places where MCE maintains investments. US Bank is the custodian for our fixed income portfolio, so any activity that Chandler does in the month is reported here. For instance, in February, Chandler sold or actually bought 2 securities totaling $2.7 million and sold 1 security totaling $1.5 million. And if we can scroll down a little bit more. As for River City Bank, we keep a portfolio of CDARs. In February, close to $18 million matured, and we reinvested $5 million into another CDAR. So if you're short on time and just want to get the gist of what happened in the previous month, the staff report is a really good place to do that. We also include a table of MCE's holdings. So February 28, 2026, MCE's total holdings were just shy of $503 million. Our average yield remains pretty strong at 4%, and that is a weighted average. And the agency's holdings are spread across the fixed income portfolio, which makes up 40% of the allocation, CDARs, which makes 11%, cash balances, which make up 48%, and collateral at the ISO, which makes up 1%. We recently requested collateral back from the ISO, so this number has gone down, but it can vary depending on where the CAISO prices are. So this is the end of the short staff report, and if we go to the next page, we get to attachment A. Attachment A is a very good summary of the holdings that are in the portfolio that Chandler Asset Management manages. So here we have a list of all the securities. We also include relevant information such as the issuer, security type, purchase date, and so forth. And if we scroll down a little bit more, you'll also notice that we highlight any new purchases into the portfolio. So in February, for instance, Chandler bought a new security from Freddie Mac, so that is highlighted here. And if we scroll down, you will notice that they also bought a new security from Visa, so it's also highlighted and shown here as well. Next page, please. So attachment B is still reporting on the portfolio, but now it narrows down the reporting to the transactions themselves. So here we see the actual purchases and sales. Again, you'll notice the 2 purchases that were highlighted above, and you will also see the sale. So they also sold 1 Freddie Mac security for $1.5 million. And let's go to the next page. Okay, so this is a really great attachment that provides performance metrics on the portfolio. There are a number of key statistics here. You can take a look at the portfolio characteristics. I think of importance here is the average purchase yield to maturity, which is 4.37%, which is very good. Average credit quality for the portfolio, which is AA+. You can also look at the sector allocation, maturity distribution, credit quality, and top issuers. And if we scroll down just a little bit, you will also notice a comparison against the benchmark return. And of course, the portfolio has consistently performed better than the benchmark since inception. Our portfolio has performed over 5% since inception versus the benchmark, which has returned at just about 4.56%. Next page, please. So this is now reporting on the activity at River City Bank. And again, here we keep a portfolio of CDARs. These are really CDs with the difference that these are spread out amongst various banks so that they all stay within the FDIC insurance limit. So we're able to have all of this FDIC insured, but we use River City Bank as the administrator, but again, the amounts are spread out among various banks. So this attachment is very similar to attachment A. We have a list of all the active CDRs, and if any new CDRs were purchased, they are also highlighted. So in February, we had a new CDR totaling $5 million, and you also see the interest rate and the annualized yield shown on the table. The overall interest rate for the CDRs portfolio was 4.30%, and the yield was 4.39%, which is also very high. Next page, please. And finally, we end with attachment E, which is we can go back to the page, great, which is a statement of transactions of River City Bank. So we see all the maturities that took place as well as the purchases. So in February, over $17 million of CDRs matured, and MCE realized a gain of about $900,000. And at the same time, we also reinvested $5 million into a new CDR. Okay, so with that, I will now open it up for discussion.
Thank you for your report, Director Wilkinson.
Thanks, Liz. Can we just go back to the page that shows the breakdown of MCE's holdings? I think it was one of the first pages on your presentation. No, the actual summary page. I think it's the first or second page of that. Oh yeah, exactly. Go to the next page. There, exactly. So Vic and I asked some questions about this yesterday, and you kindly sent me some information which might be useful to share with the rest of the committee as well in terms of the breakdown of those cash balances. And I know you also explained that those cash balances were unusually high because of uncertainty regarding the board's decision around rate setting and the budget. But I would like to understand more fully on a sort of more rolling basis, how much cash are you keeping versus putting it into the investment portfolio?
Okay. You mean at the
you just have cash balances of 238 million here, which is just an extraordinary amount of money to be keeping in cash and generating a lower return than what you're putting in your investment portfolio. And yeah. I think you said to me yesterday you need to maintain a minimum of 40 million, and I think there's some other requirements as well. But I want to know, how much is that cash balance normally? What is a sort of norm that you're running in cash?
Okay. Efren, you want to answer that question, please?
Yeah. Thank you for the question, Director Wilkinson. So there's no cap at the moment on how much cash we can have in the at River City Bank. It's not something that's outlined in the policy. What we do is we generally look at what the liquidity needs are for the agency in the coming months, and then we make an assumption on that. But as you stated, the cash balances are higher than usual. I think that's a fair assessment. And there was a lot of uncertainty of where revenue was going to be for the coming fiscal year, right? There were some very aggressive rate reduction options that could have decreased revenue year over year by over $250 million. So we wanted to be able to absorb whatever option your board ultimately chose. And now that we have certainty, or at least more clarity on what revenue is, we can think about deploying this cash and send additional to Chandler, or reinvest in CDRs, or seek another allowable investment vehicle.
But so what would be the norm? The norm is what, 100 million? What is the norm that you'd just be keeping there?
I think it varies, Director Wilkinson. For instance, in summer months, bills can be as high as $60 million. And it is a snapshot in time, so it also changes depending on the day that you look at the balances. But I would say it varies between 100 and 150.
Okay, so that's just a large number, because obviously this isn't such a bad thing when you've got a flat yield curve, but once you start to have a steeper yield curve, it feels like you need to more actively be managing that cash.
Yes, and we can think about deploying more to Chandler now that we have greater clarity on revenue. So we can. Yeah.
Thank you.
Thank you for that explanation. That makes a lot of sense and helpful. Thank you for the question, Director. Director or Vice Chair McCormick.
Yeah, thanks. I was actually kind of curious about the cash as well, and it makes sense, especially now that the rate decision is made, we can allocate a little bit more. I was also just curious. We're measuring against the benchmark, and it looks like we're doing pretty well. What is the benchmark? What benchmark are we using as our anchor there?
I'm gonna pass this off to Daniel, who is here from Chandler, and maybe we can go down to that page. It's attachment C here on the report.
Thanks, Ephraim. Well, good morning, directors. Good morning, staff. I just quickly introduce myself. My name is Daniel Delaney. I serve as the Deputy Chief Investment Officer at Chandler Asset Management. You're used to seeing Carlos Oblites, my colleague, of course. Carlos has been called away to jury duty and is fulfilling his civic obligations. So I'll try my best to emulate him. I know he always does a good job. I'm also in charge of the day-to-day portfolio management for MCE, so I can hopefully provide good insights to the portfolio. To answer the question about the benchmark is a broadly used benchmark for all of our local agency portfolios. It is a treasury and agency benchmark, but it is predominantly a treasury benchmark. About 97-98% of that benchmark is treasury securities because the treasury market just dwarfs the agency market. It is the broadest benchmark that we use and we think the most appropriate one for local agency portfolios. It does not include some of the other sectors that we invest in, the non-government sectors such as corporates or agency mortgages, for example.
Right, which means is why we're able to exceed it slightly, at least now. Perfect.
Yep.
Great. No, it looks good. I mean, it's obviously a very conservative portfolio, but given where we are and our responsibilities, it makes sense. Thank you.
Yep. Welcome.
Sure. Director Andre.
Great, thank you. Following up on the benchmark question, does it make sense because we do hold some corporates to have a blended benchmark of treasuries and corporates to better reflect, the composition of this portfolio?
You could use that. Some of your peers do use that, which you may be aware of. There is a benchmark that does include some corporate exposure, and so we could absolutely explore that option.
Okay, yeah, if you could maybe show that benchmark as well, it'd be helpful.
Sure.
To see how our returns are matching up against a blended benchmark. My question actually has to do with River City Bank, where, well, first of all, it'd be helpful to see the statements for the cash balances. I mean, 48% of our portfolio is in cash balances, and I didn't see a statement, whether it's with JP Morgan or with River City Bank. But it'd be helpful to see a statement and see what instruments or securities were actually invested in for the $238 million. And with respect to River City Bank, I just wanted to, I'm not familiar with them, so I did some research, and it looks like they're a small bank comparatively to other banks. And the last time they were rated in 2023, they were BBB minus with a negative watch on S&P. So I'm just curious about how do we think about counterparty risk here or financial institution risk, where we have a significant amount of our assets at River City. Do we bid out that business on a periodic basis just to make sure that we're choosing a financial institution that we feel is appropriate for our cash?
Thank you, Director Andre. Who would like to answer or respond to her question?
I'll give it a shot. So, thank you, Director Andre. So, River City was our, first bank, the regional bank that trusted us, the CCA movement, and we went. They helped us establish credit, and they provide an amazing service to us. In their what they provide in interest is really great. Now, having the risks that we have seen like 2 years ago, 3 years ago with some regional banks, we went ahead and diversified with a very large bank that their fees are quite high and they don't give that much interest on our money to make sure that we have the coverage. But we have not done, I'm sorry, you said like bid out service or something. We haven't done anything like that, but they provide very reliable service. Um, it's complicated to serve our all those cedars, and again, between the staff, they provide great value. But that is something we can think about. What you're talking.
Okay, great. Yeah, I'm just worried about, yes, like Silicon Valley Bank, a regional bank that went under,
Yeah,
a few years ago. I think
yeah,
there was some risk here that would probably,
yeah,
it doesn't hurt to do a market check every so often and maybe diversify
yeah.
the banking institutions that we do business with. Thank you.
Yeah, sure. And one more thing, once a year, maybe in this time, around this time next year, I can let you all know that they have an annual get together on the business outlook. It participates from a lot of Northern California big banks and big institutions and big corporations. They attend. It would be good to attend those meetings to see their exposure, how they're doing, what's going on. So I'm just thinking and talking at the same time to get you to know a little bit more about them too. It may help.
And Vic, and if I may, our deposits with River City Bank are also collateralized by 110% Director Andre per government code. So that's also one way that we limit our risk. And as Vicken said, in addition to the great customer service that we receive from River City Bank, they also pay the late rate plus 5 basis points on our deposits. So we're able to take advantage of that.
Yeah.
Okay.
That response. And I do agree that it's really important to have, we want to make sure that the institution is sound. And I appreciate that concern. We also need to recognize that when you have a really good relationship with a bank, it really is, it's very, very helpful to the agency, to have a relationship, that sounds like that we have and have established with this institution. Director Wilkinson, you have another question? Oh, you're muted.
I was just going to add on there, backing up that we should be looking always or on a regular basis to look at comps for that, because the amount of cash we have there, any bank is going to give you good service when you're dealing with that level of liquidity. And I continue to worry about the fact that a large number of CCAs seem to be with River City Bank, and on their asset side, they have a lot of real estate. And I just worry about a run on cash. And whilst everything might be securitized or collateralized, sorry, that doesn't mean that there's zero risk. And so I do think the agency should be continuing to look at alternatives and going to some of the bigger, more secure institutions just to see what their service might look like.
Yeah, I would concur with that. But again, I think annually, we've done that. We're on several other boards, small and this, of course, and Silicon Valley Bank experience jarred everybody. And every group that I'm on, looked for some sort of diversification. So the CDARs are great. So I think we're protected there. But no, I agree. It's worth looking around.
Dan, could you go to the first or second page where there was the summary table? I just want to make a comment. Oh, yes, this one. I just want to let the board members know that the collateral that we have with the CAISO varies significantly as the summer is getting nearer with prices going up. They require more collateral. So in the near future, don't be surprised in seeing more than $20 million there, because the way they do the formulas is that, whenever the bills are coming, we have enough to pay for it. So, and we, finance is very active in making sure that we have just the right amount of money, with the CAISO. That's all. Thank you.
Thank you for giving us that heads up. I don't see any other directors with questions. Do we have any public comment?
I'm seeing no raised hands online, Chair.
Okay, very good. Very good. Let's go ahead and move on to item number 7, and this is the accounting function and MCE's financial statements with Maher Accountancy. And who will be presenting this presentation? And this is informational.
Yeah, Mike Maher. Mike?
Yes.
Okay, perfect.
Thank you. Yeah. My name is Mike Maher with Maher Accountancy. We assist MC with the back office accounting function, and we have since the inception of MCE. So we're very familiar with MCE Finances and the organization. So what I've been asked to do today, just go over the most recent quarterly financial statements, the December 31 financial statements. And actually, this is a great place to start. So let's actually go back to the engagement letter, or the compilation letter. So sometimes we do presentations, or you guys probably have more familiar with financial reporting than the layperson, but a lot of times we get asked, why does this report say that we're not independent or that this is not an audit? And so I just want to be clear, because we are so involved with preparing these financial statements, we're not considered independent from the AICPA. So we add this letter not to scare people off, to say we're not independent, but to disclaim that we are not the auditors, that we prepare these financial statements. So one's also testing the financial statements. So that tends to come up. You all probably are aware of that, but I just want to make mention of that. Okay, so let's get to it. Next page. Okay, so this is a statement of position in the government world, right? We call it that. In the private, you might call it balance sheet, but it's structured very, very similarly. MCE follows an accrual basis, full accrual basis, just like a private agency. So a lot of consistency there with the accounting. There are some differences in the GASB, Governmental Accounting Standards Board, but for the most part, this type of government entity follows what's called an enterprise fund. So it doesn't have the multiple funds that you might see at a city, right? This is an enterprise fund treated like a business for the most part. Okay, so some of the big items up top we just had a conversation about, the cash and cash equivalents. This, even though it says cash and cash equivalents, this might include some items that are considered investments on the investment report. So items like money market, mutual funds, certain CDRs that are monthly CDs, investments that are bought with less than 3 months to maturity are considered cash equivalents. So sometimes there are some questions of tying these cash numbers and what we'll get into, the investment numbers, to those investment reports. That's often one of the reasons, is some of those investments are considered cash equivalent. Some of the restrictions on the cash are restrictions for grant purposes. So we receive money from grantors in advance of spending the related money. And so we hold the money in advance. There's also a corresponding deferred liability. And as we incur costs, eligible costs for the grant, we recognize revenue and decrease the liability. But in the meantime, the cash we hold, we consider restricted for that purpose. Can't be used for any other reason. And similarly, the next line, restricted for security reserve, that is money we have to put aside for our, I think it's a restricted balance that our lender for our letter of credit requires, as well as, I think Vicken mentioned that FSR reserve. So about $2 million of that is cash that we've posted. I think it may be collateral on a letter of credit for that posting, but that is money set aside partly for that FSR we were just talking about. One of the largest non-cash items on the balance sheet in the asset section is accounts receivable, net of allowance. So that's pretty obvious. We know what that is. These are charges that we have billed out to customers that they have not yet paid, and it's net of an allowance for bad debt. Related, on the next line, accrued revenue, that is unbilled revenues. So we bill customers once a month, but they're using energy every day. And so when we get to a cutoff period or report end, we will estimate what the revenue from that will be, and we record the revenue for that. So that's before it actually gets billed, before the meter has been finalized and the customers sent an invoice. So let's maybe skip down to the liability section there. So our largest, and that same report, but the liability section. So the largest liability we have is the accrued cost of electricity. So these are Energy purchases, items that we've been either are estimating or we've been billed but have not paid yet. They're not due. So those are very current. For the most part, those things are going to be paid within 30 days, 60 days, something like that. Sometimes I kind of skipped over it, but above in the asset section, there's prepaid expenses. Sometimes we'll prepay for energy. Sometimes it's in arrears. But anyway, that represents the cost of electricity that we owe at this time. The one item which is not something you will see on a private business balance sheet is that deferred inflow of resources. I think you probably all are aware of that. That's $70 million. That's the rate stabilization reserve or the operating reserve fund. So that's a deferral, if you will, of revenue that will be used and in future years or maybe added upon. So that is an unusual item. And of course, that does not affect your net position. The net position is your assets minus liabilities minus that deferred inflow. That's what you have remaining. Okay, maybe we can go into the next page. I know I don't have all day to talk, so I'll maybe just get through this and I'll see if there are any questions. Operating revenues, this is a very condensed statement, obviously, but electricity sales, net of your bad debt, that includes sales for commercial accounts, residential accounts, other accounts. That is your main revenue source, okay, and that's reported net of bad debt as well. Grant revenue, I touched on that earlier. That's from a variety of different grantors, but that is revenue that we've earned by incurring related grant expenses, rebates, implementing other programs, et cetera. And the operating expenses, cost of electricity, is clearly no surprise, our biggest expense. That includes conventional energy, renewable energy, CAISO pass-throughs, resettlements, all of that. Okay, and then contract services, big piece of that is PG&E fees, data manager fees at SMUD. It does include other implementer fees for our programs, right, that are partly funded by or fully funded by the grant revenue. Okay, and then we have staff compensation, that's salaries, benefits, accrued compensated, absence liabilities, and so on. So those are some of the big items. There's also a cash flow statement, which we can get into. That's pretty fun if you want to talk about that. But that's kind of just a high level summary of some of the items that go into these statements. So I know you guys, we present these quarterly. So this is a little bit, we're already in March and this is a December 31 statement. But I think it's still helpful to kind of go over what you're seeing when you do see these. So I'll conclude there and open up the questions.
Thank you, Mr. Maher. If I can just start off with a quick question. Is this a standard financial report for other like companies, agencies?
Absolutely. This is very standard. In fact, we work with several other CCAs. So we are very familiar with how the reporting is and what the other CCAs are doing. And this is very consistent. Yes.
Excellent. Thank you. Vice Chair McCormick.
Great. Thank you very much. No, it's obviously a very solid, I guess we won't call it it's not balance sheet, but whatever. It seems good. I guess it's a question, maybe it's for Vicken or for you. So I'm just kind of curious that the reserve, so it's interesting. So the reserve, the deferred inflow is still counted against our net position. That's correct? Even though it's not, we haven't recognized it yet?
It reduces it's not included in your position.
It's not. Okay, it's ignored.
So you can think of it as, if you thought of it maybe as a liability or something you have to give back.
Right.
Okay? That means you have something, an asset. So we maybe have cash.
Yeah, you're right. It's more like liability.
Yeah. So It's offsets by the time
Great.
it's in that position.
And so maybe this is a question then, just kind of thinking how, because this number is obviously, when we talk about the rate reduction, that number is going to go down a lot. Obviously, we think we agreed that we are going to spend a lot of that for rate reduction. But then we also talked about, because right now I think we are procedural by policy cap is 70 million. But we also talked about potentially raising that bar a little bit. So I'm just kind of curious, just looking forward a little bit, how should we expect I mean, it's just interesting because our net position is going to be kind of wildly fluctuated as this reserve, we were spending it down and building it up again. I'm just kind of curious, like, what we should expect to see over the next, 6, 12 months as we start really using it.
Mike, may I?
Sure.
Yeah, sure. Yeah, absolutely. We're looking forward to having this discussion once we kind of bring the closure of this fiscal year, which I'm really glad to say that is looking a lot more positive than we thought at the beginning.
Great.
So our thinking is to, there is a board policy that says we can do so much saving or deferring of income from our net position in replenishing the operating reserve fund, and it has a cap that was sitting there about 70 million, which will be used. So we will bring for discussion saying that, okay, we have this much, we can have an opportunity maybe to replenish probably half back with our excess. And we'll have a good discussion about that. But that is our thinking, that how do we replenish this buffer for any future use that may come up again. I hope I answered the
No,
question.
we'll look forward to it. Yeah, I guess I'm just thinking that number is going to be it's going to be changing a lot over the next 12, 15 months, whatever.
Yeah.
That's fine. That's fine for now. I look forward to the discussion in the future.
Thank you. Thank you, Director. Director Andre, please.
Thank you for the presentation, Mike. I guess my question is more to do with, and I sent an email yesterday to Vicken and Maida. I really appreciate seeing the financial statements. I feel like as the Finance Committee, it'd be helpful if we got a little more detail. And so I guess my question is really for management is, can you show us the actuals versus budget, and then also actuals versus the prior year, the same period the prior year? That way we can have some comparability just to see how we're tracking to budget and also how we're tracking year over year. That I think that would be really helpful to see. And I know Mike Maher does a great job, and he does accounting for several other CCAs. So the financial statements are actually pretty comparable from CCA to CCA, which I really appreciate. And then secondly, was hoping that maybe staff could just break down the cost of electricity, because it is such a huge component of our expenses. If we could break down the cost of electricity into the 6 major buckets and also be tracking those versus budget, that way we can see, how are we doing on our long-term PPAs versus budget, the CAISO hedges versus budget, all those separate categories for just to get a little more granularity into the cost of electricity. Thank you.
Yeah, and if I could jump, or go ahead, Vicken.
It's okay. Go ahead, Don. Thank you.
Well, I was just going to say at a high level, and then I'd love to defer to staff to comment on the specific requests. I just wanted to flag that we did do quite a bit of reworking of the reports based on your requests last fall. Director Andre, you may recall quite a few adjustments that you requested at that time. That did end up taking quite a bit of staff time and dollars for the agency to spend reworking the reports. There might be some easy adjustments that we could make. I think some of what you're looking for is already there. Some of it might be easy fixes, but anything that would be time consuming might be something that would be good to get input from the board as a whole to make sure that we're spending staff time on the right priorities, because I expect different board members may have different things on their wish list of what they'd like to see in the financial reports. So that kind of the re-slicing and dicing and showing things in different ways can actually be quite time consuming. So I just wanted to flag that. But with that being said, I'd love to allow the staff on our finance team or Vicken to comment further on the specifics of your requests.
Yeah, Director Andre, thank you, Don. Director Andre, we'll look into it, like Don said. And are you specifically looking at this report, or it's a general question about comparisons that you are looking for?
Yeah, so I mean, Don mentioned the quarterly report. So I think once a quarter, you all have a more fulsome treasurer's report that wasn't attached to this. I think that report contains some of the information that I'm looking for. Although I think breaking down the cost of electricity into just more granularity for us, because that is such a large expense item, I think would be very helpful. And I'm not saying that this needs to go to the board. I think as a finance committee, we are charged with, getting more granular with the finances. And so I think it'd be very helpful just to, see a little more detail around the energy costs. And we can talk about, the hope is that we can standardize a report for the finance committee so that once that we figure out what it is that this committee wants to see, that it's easy for staff to just generate the reports and, we can all look at it. And it's just a better way for the committee to be able to monitor what is going on with the finances, versus budget, and to spot any trends before they arise. Now, I know there's a lag here. It's a 3-month lag here on the financial statements from the accountant, but it's if we can get to a point where we are looking at this more frequently on a monthly or bi-monthly basis, I think it would be helpful for the committee.
Wow.
If I may, begin. So,
Yeah.
I think those requests are doable, Director Andre. I would just mention a couple of things. I think one, we can certainly model the income statement as well as the balance sheet, but it's not going to be a one-to-one with the budgets. As you know, the budgets are shown a bit differently. They're shown net of grant reimbursements, whereas the statements themselves, they capture everything as a whole. So I think maybe it warrants further discussion to see exactly what you would like to see, or what the rest of the committee would like to see on those reports. Again, I think just got to think about how it's going to vary from the budget reports themselves, which are a bit different.
Mr. Maher, based on the question of Director Andre, how does that resonate with you? Because, and again, Director Andre, with all respect, I want us to stay within our lane of oversight and not cross over into what staff is hired to do. So I think that we need to be distinguished what we do as a board and as a subcommittee of the board, and the cost of generating this information that you want and the value it brings in terms of our oversight. But Mr. Maher, what are your thoughts on this request based on your experience with other CCAs?
Yeah, no, it's I think that it's kind of sounds like a mix of the budget to actual request and then these main financial requests. So there's some different reporting, but what I'm thinking of is, and I apologize, but on the quarterly treasury reports, is this included with the budget to actual?
It is.
It is. So
yeah.
My first thought is, wow, I'm reading that and I'm seeing the budget actual, which does compare at least to this year's expectations, not to last year, which that's kind of more of the can of worms. The last year, that comparison can be tough. But to tie the financial statements, or at least the statement of revenues, expenses, to the budget, I think that's very reasonable and something that we see and we can do. So what that is you have the statement of revenues, is one we're seeing here, and then you have your budget or budgets, but then we report a third report that's a reconciliation back to these financial statements. So that connects it, but that comparability, that comparison, I think is typically done on the budget to actual. One thing I like to see sometimes on the statements, on these financial statements, is a quarterly and year to date. So, show this. The balance sheet, of course, is not, right? That's a point in time. So you don't compare that in the same sense. You might have benchmarks, but that's not what you would typically see. But on these year to date, so the statement, this one, and the statement of cash flows may be showing on a quarterly basis that quarter and the year to date. I think that would help from just a reader of the financial statements, and we have done that in the past. So that is not a huge lift to add the quarters to these statements. But again, the comparison to projections or budget is not really done here. That's done on the budget actual. That's the intent of it.
Mike, can I jump in there because
Sure, sure. I was going to call on you. I was just waiting for Mr. Maher to finish.
Yeah, that's fine. I think we can move.
So Mike, I agree with you. These are two separate items, and so I agree also with your statement there, and it was something I was going to ask for as to whether you can include quarterly as well as the year to date, because I think that is helpful just in terms of looking at trends and volatility and all of those things. But I agree with Director Andre that we need more transparency and more, particularly on the energy side. So I would just suggest as a completely separate report, just give us the breakdown of energy on a quarterly basis versus budget for the 6 items. And that shouldn't be, you guys are clearly tracking that, and that isn't a large report. And that I think would allow the Finance Committee to see whether any of those components are diverging significantly from budget, so that we'd have that level of transparency.
Again, I want to make sure. I don't know how much staff time will that take, and maybe Mr. Maher's time. And is that appropriate for us to be looking at? I don't know how this information.
I don't think that would take up any of Mike's time, because that's not really his area, and I don't think we want these financial statements to differ significantly from other CCAs, because that would just be weird. I think this is just a separate report that's just looking at our energy costs and seeing how they're developing versus budget, and that isn't something that's difficult to do.
Okay. And I don't know how those trends work year to year, based on, energy. So if I can ask, and then Director Andre, I'll go back to you in just a second. Just asking staff, do we have an idea how accessible this information is and how much time this would take? Are you comfortable disclosing this information to the public?
Yeah, let's just take it and come back to you. I need to look into this and talk with staff and Mike and what have you, and get back to see what it is that we can do, especially in an open meeting. Yes.
Okay.
Let's get back to you.
Okay, we'll do that then. We'll add that to. Let's go ahead and make a note for that to be. Would that be okay at our next meeting, or do you need a couple meetings? Can we add that to the agenda on the next meeting?
We can put a placeholder for next meeting and see if we can make it. Yeah.
Okay, perfect. And Director Andre, thank you for your patience.
Great. Yeah, I just wanted to say, I agree with Mike. I think, the year to date and the quarterly actuals versus budget, I think I'm primarily focused on the statement of net position or the statement of revenues. I don't think we need to do it for all 3 statements when we're trying to track the, budget versus actuals. So it's just that one statement where I think it's appropriate. And then, the balance sheet, as you say, is a point in time. So, so we don't need to do all 3 statements is what I'm saying in terms of what I'm asking for, reducing the, I didn't want people to think that I was asking for a full year-to-date comparison budget versus actuals for all 3 statements. I'm really focused on the statement of net position and also the energy costs. Thank you.
Okay, just to kind of repeat that. So the statement of net position is synonymous with the balance sheet. So not that one, but this is the one that you're looking at.
Sorry, yes, statement of revenues. Statement of revenues. The income statement, which is what what I typically call the income statement. Sorry.
Yeah, this is the most awkwardly worded title that I don't know why they haven't figured something else out.
Yes.
Yeah. Okay.
I'm primarily focused on the income statement. Yes.
Okay. I like doing it on the cash flow statement as well, honestly, if you're going to go for it. So I'll put that on the list, and we can do that next quarter, which happens to be the year end, but we can start implementing that.
Yeah. And I think the cash flow statement is going to come into play this year because we are going to be drawing down on the rate stabilization fund. And so while the net position won't be changing, when we draw on the funds, it will be impacting our cash. And so I think the cash flow statement is going to be pretty key in this upcoming year.
Okay. Mike, thank you for the presentation and answering the question. I just request that Efren and you please connect for both of us to be on the same page when we're moving. Thank you. Okay.
Thank you very much. I think we're done with questions here. Do we have any public comments on this?
I see a raised hand by Dan Sagedin.
Okay, Mr. Segedin, you have 3 minutes whenever you can click on it. And then, are you, Mr. Hello, Dan? You still there? Dan?
Hi, Dan. You have permission to speak now.
Can you hear me?
Yes, now we can hear you. Thank you.
Thank you. Just wanted to say that you've done good reporting on the components of energy costs before. At the board retreat, you had trended for 3 years of the 6 components. It might have even been 8. You might have included sales and other. You've also done reporting on this where you showed in the budget, you showed the Super 6 and you showed the components. So I assume you guys have good reporting systems. Efron seems really on it. I assume this would be kind of easy to show and break out and would not involve staff time. And I'd also say, I mean, given how big energy costs are, and that's what's going to cause the swing in your financials, you can't really be analyzing or doing anything significant without having that breakout. So I would encourage management to figure out a way to get that done, as you've already done, as you've done good reporting on this. Just see the past board retreat and some of your budget presentations where you show the Super 6, either pie charts or trended bar charts. Thank you.
Director Alicio, I would like to do a quick answer here for Dan as well. I just want to say that we are outside of the parameters of the boundaries of finance in this discussion. We really need to get involved with the power resources because they did some really heavy lifting to get all that data involved. Finance deals with the finals. So we'll look at it to see what it is that we can readily do, and we'll go from there. But I just wanted to recognize that we're getting a little bit further out than what finance sees regularly.
Thank you. Appreciate that.
Okay.
Is there any other public comment?
I see no additional hands raised on Zoom.
Oh, perfect. Okay. We're on item number 8, and this is MCE's investment portfolio with Chandler Asset Management. It's a presentation that's informational. Just let everybody know we have the committee and staff announcements afterwards and then adjournment. We're now at 11:09 and this meeting does conclude at 11:30. Please start the presentation.
Thank you, Madam Chair. I'll keep it brief. We start with the economic backdrop, as always, and then try and tie it into the portfolio so we can flip to the next slide. So we focus on employment because, of course, the US is a consumer economy and job security and wage growth are the biggest drivers of spending. You can see there that employment growth or payroll growth has been slowing. But going into this year, our expectation was that there would be some fiscal boost from the One Big Beautiful Bill last year that would spur consumption, spur business investment, and keep that unemployment low and keep growth at a pretty solid clip. On the other chart, you can see inflation, and obviously we did this the big jump through 2022 and 2023, and inflation had been heading lower, closer to the Fed's 2% annual target, and some of the more sticky components of inflation, particularly rents, had also been coming down. So going into the year, we were quite optimistic. Clearly, recent events in the Middle East pose some risks to that view on both the growth and inflation side. And you'll hear a lot of talk, particularly in the news, about the duration of the conflict. And that's important because clearly that weighs on consumption decisions and business investment decisions, but also importantly, inflation expectations. And that is what the Fed is particularly worried about. And we can flip to the next slide. So the first chart is the chart of the Fed funds rate. And after peaking at around 5.5%, it had been coming down. And we're currently at a range of 3.5% to 3.75%. And of course, the Fed has a dual mandate, wants to keep unemployment low, which it is, but also keep inflation low, which has been coming down. However, if the Fed does start to see risks to the inflation view, and there was a Fed meeting the other week, and it highlighted this, then it could change its view on interest rates, and instead of cutting rates, which it was expected to do this year, it may turn to holding rates. And if those inflation expectations really become out of control, and that is not our base case, we do see promise that there'll be some de-escalation and commodity prices easing. Then, of course, like other central banks around the world, there is the opportunity potentially to increase rates again. Again, that is not our base case. In our view, that's a remote possibility. On the other chart, you see Treasury yields. Treasury yields have been coming down alongside the Fed funds rate. What you've seen in the last month or so is a lot of volatility across all different markets, including the Treasury market. We have seen yields in the last few weeks increase as those Fed cuts for this year have been priced out. Again, for yields to increase more from here, we would have to start pricing in rate increases, which again, we think is a remote possibility at this stage. What I really want to leave you all with today is comfort in the portfolio that one, on the growth side, you have a portfolio of superior credit quality. So if growth does start to falter, all of those non-government investments that we own, those credit investments in your portfolio, can withstand a slowdown. And the other thing on the inflation side and interest rate risk side is that you have a very low sensitivity to interest rates in your portfolio. As you've seen, the majority of your portfolio is held in cash and cash-like investments with very, very low sensitivity. But the portion that we manage, and we can flip to the next slide and talk about it a little bit, also has a relatively low sensitivity to interest rates. So here's a reminder of the objectives: safety, liquidity, number one and number two. And if we follow those two objectives, returns will follow. We have a benchmark we mentioned. Our job is to outperform that consistently in a way that you can all sleep well at night and not introduce too much volatility to the portfolio and add value. And we do that. Our strategy is to diversify across all of the different high quality investments that are permitted by California code and your policy, which is in very good shape. We analyze that policy to make sure it's current with changes in code and industry best practices. And it allows us at Chandler to add the most value to the portfolio within the parameters of code. We can go to the next slide. This is a snapshot of the portfolio as of the end of December versus the end of September. You can see the average maturity, again, quite low, around 3 years, and the duration a little lower because some bonds pay before they mature, around 2.5 years. So that is a really key metric there. That tells us how sensitive the portfolio is to a change in interest rates. For example, if interest rates were to rise by 1%, the value of the portfolio would go down by 2.5%. So an instantaneous 1% move up would reduce the value by 2.5%. Again, that is not our expectation, but it gives you some idea as to the sensitivity. The other good thing now that we're in a high yield environment than we were, 5-10 years ago, is that you are currently clipping a coupon of around 4.5% in your portfolio. And I would say that is the envy of many public agencies. So that 4.5% will protect you from any increases in interest rates. Again, if rates were to go up by 2.5%, you would be covering that by earning an income of 4.5%, very handsomely covering that loss. Market yields did fall slightly during the quarter, and so the value of the investment portfolio went up slightly by around $2 million to $202 million. And you can see the average quality is superior there at AA+. We can flip to the next slide. So this talks to the credit quality of the portfolio. We have a core holding in treasuries. Treasuries are the most safe and liquid investments that we own. When you see markets volatile as they have been, those markets still function very well. So that's always going to be a core holding. And then around that, we build in some, again, very high quality liquid sectors, but ones that offer additional yield. So corporates, agency mortgages, AAA rated asset-backed securities. And these percentages don't really change too much. We want to stay diversified and again, keep that core holding in treasuries and build in some additional yield. And we can go to the next slide. This shows the diversification of the portfolio by maturity. So for example, if you were to need liquidity from this portfolio and did not want to sell any investments, we could simply stop trading and let the bonds run off and mature in the portfolio. You can see within 1 year, you have 10, 15% of the portfolio maturing within a year. And the next slide. We spoke about this briefly. The performance has been pretty stellar. Last year was an incredible year for bonds. Of course, if you go back to 2022, it was the worst year on record for bonds. And so, the last few years have been rebounding from that. So we returned just over 6% in the last 12 months. I would anticipate that in this calendar year, you would get a return closer to that purchase yield of your portfolio, around 4 to 5%. And finally, I want to commend staff in terms of the timing of setting this up. And we set it up at a time where interest rates were very close to their peak, and it made sense to extend duration. And we started off with a portfolio of 20 million. It has grown to 200 million. All of the inflows and additions to the portfolio have been very deliberate, very methodical. And I think it's something that you can all be very proud of in terms of its performance. And again, just want to highlight the resilience despite all of the noise going on right now and volatility in the markets. And thank you for your support in allowing us to be stewards of this portfolio. Happy to take any questions.
Thank you. And I like how you ended it with such great assessment and news. I guess, Director Wilkinson.
Thanks, Liz. Daniel, thank you for the presentation. I had a quick question. It doesn't look like this portfolio is actively traded. It seems like you tend to sit on investments for a long time. Can you sort of just talk about your philosophy there?
Absolutely. So what we want to do, number one, is stay aligned with the benchmark in terms of our duration. And every month, the benchmark will lose a little bit of that as bonds pull closer to par. So that will involve a transaction, and Efren showed you one whereby we sold a shorter bond and extended into a longer bond. So that's part of that. That's typical every month, 1 or 2 trades in order to extend duration. We can be more tactical sometimes where we see opportunities, particularly in the new issue market, where there are issuers that we think are very compelling in terms of their fundamental credit fundamentals and also valuations to engage in those new issues. But I would say in general, we try and keep turnover relatively low because there's a cost attached to that. So maybe 2 to 3 trades every month that will get us aligned with those targets and take advantage of opportunities. Right now, honestly, we're not doing anything. And I think there's just too much uncertainty in the markets in order to transact in terms of adding to our credit risk. And as you've seen, there's been a lot of volatility in the treasury market, in the interest rate market as well. So we are being more guarded when it comes to even purchasing treasury bonds and extending our duration. We had been happy to hold a duration slightly longer than the benchmark up until now. And now our position is to be much more closer aligned to the benchmark. So when you look back at the last month or so, you will see less transactions than usual.
Okay. And I don't follow this stuff so closely anymore, but what has the Fed been doing, or how effective has it been in draining all of that liquidity? I mean, do they still have a very large balance sheet?
They do have a very large balance sheet, and what they had been doing is allowing that balance sheet to run off up until the end of last year. And what you may have seen was some concerns, particularly in the money markets, and we manage a number of money market funds, where funding rates were very elevated, and there was definitely some concerns about liquidity. So the Fed has stopped running off its balance sheet, and what it is doing now is anything that matures from its balance sheet is reinvesting in treasury bills. And that is providing a lot of support, particularly to the money markets, but I would say to the treasury market in general, the fact that it is not allowing its balance sheet to run off and is reinvesting in bills. There's going to be a new chair soon, we think. There's one nominated, and it'll be interesting to see what the new look chair's view is on the balance sheet, because it has swelled to a extremely high number, and certainly the nominee's views was to try and get that down. But you also have to marry that against the huge deficit that we have as a country. And is the Fed able to do that and to really step out of the market as we're continuing with these deficits? But it's definitely been a help not having that balance sheet runoff, particularly to the money markets.
Thank you for that. And then I just wanted to echo other directors' comments about needing a second benchmark here, because the benchmark that you're using right now is lower risk than your portfolio by quite a large amount. And so there is, I look quickly, there is a 1 to 5 year government credit benchmark, which looks like it's a better fit. I know it takes all investment grade credit, so that's not a perfect fit, but it's closer than the benchmark that you seem to be benchmarking against right now. So I think next time you bring that back, you should definitely include those two benchmarks so we can see how you comp on an apples to apples basis.
We can definitely do that, Director.
Okay, thank you.
Thank
Thank you.
you. I appreciate that. Thank you so much, Mr. Delaney. I don't see any other director questions. Do we have any public comment?
I see no raised hands online, Chair.
Okay, thank you so much, Mr. Delaney. Moving on to item 9, this is committee and staff announcements. Do we have any announcements from staff or from the committee? Not seeing any. Okay, very good. Then we'll go ahead and adjourn this meeting at 11:23. Let's see here. The next meeting is going to be, I'll look at my calendar here, old-fashioned way. See.
April 23rd, I think, right?
Yep, that's it. That's what I find. Oh, it's my nephew's birthday that day. Oh no, it's an anniversary in the family. It's on my family calendar here. So yes, April 23rd, same time, and this will be at 10 a.m. until 11:30. Thank you, everybody. Thank you, staff, for all your great work and
Thank you,
all
staff.
this.
Thank you.
Thanks, everyone.
Thanks, Chair.
Thank you.
Thank
Bye-bye.
you.